Now, war volatility aside, central banks and sovereign entities are increasingly aware that the Fed is caught in an impossible trap. And following the short-term dollar funding crisis, they're now hedging these inevitable risks with gold. So the Fed is trapped. Of course, this is now time to start hedging those risks. And this will serve to offset the initial mechanical gold to real rate correlations, which have been so closely correlated. Now, triggered by the unfactored inflationary oil shock, which, given it'll take years because of the damage that's been done, and in some cases up to 5 years to repair the infrastructure, it's going to take years, one way or the other, to normalize energy supplies. And the Fed, as I say, can't cut rates, but they can't raise rates without accelerating a 36.2 trillion national debt service spiral. And that is just the official numbers. It's far larger than that. Now, the only available choices for the Fed are to monetize or trigger a debt crisis. One way or the other, something's got to happen. This is exactly the cycle inflection point our liquidity providers are now being asked to buy gold to accommodate. And under the chart noise, central banks and sovereigns are already front-running this scenario. Hence, gold buying has stepped up. This is the inflection trigger point for the gold trade to reverse, which has always followed every single such derivative physical gold price suppression event. Gold rallies back, recharged. There's no speculators on board to rinse. And it makes new highs. So let's put this into perspective with the largest ever historical PPT gold price correction. Let's look at it. So here are the footprints that led up to a 4-year, 45% PPT-driven correction, which occurred from here to here. Now, bearing in mind, while the scale of this seems muted compared to what we've just witnessed, obviously, from a scale perspective, this is a far less. This was only 27%, and with an 8% rally, this which was a 4-year, 45% PPT-driven correction, which directly followed the 2008 banking collapse, where, following a very similar to what we're seeing right now, black swan dollar funding shortage, evidence gold. So really, we saw that initial selling that to meet that. And again, this was hedges being called in. So essentially, to meet that, what that did was essentially, as soon as that was done, gold demand accelerated into what was really the fear of another collapse of the broken banking system. And this drove gold. I mean, really, they were racing to exchange debt-based dollars for gold. It drove gold from 680 in 2008 into the 1923-2011 highs here. And this 3-year gold accumulation period encompassed a period where the IMF had refused to allow the PBOC to buy 200 tons of its last ever gold sale. And if you remember, this was the 403 metric tons, the last ever sale by the IMF, where 200 tons was sold to India, and the remaining 203 odd tons was drawn back into inventory for the sole purpose of manipulating the markets or capping gold. The reason we know that is because China offered to buy the remaining 203.3 metric tons at market and were refused that sale. And it was this point in 2010 that China opened up its gold market to its citizens, and basically this. Do you remember that the house size gold billboards and television adverts to buy gold? But the physically driven rally saw gold leaving the West on a one-way journey to China. And what it did was disrupt the PPT derivative game, exposing the divergence between COMEX and LBMA derivative gold. And the shrinking supply began to expose the degree of gold rehypothecation. And this was a major problem for the bullion banks. So the reason I bring this up is relevant to now. Fresh off the 2008 banking collapse, with faith lost in the system, by the end of March 2013, which I've marked here because that was a really relevant point to actually look at now. So basically, this was the moment that the physical delivery requests seriously overwhelmed the COMEX and the RBMA. I mean, noticeably, and their ability to deliver into these delivery requests. And this is when we published a client letter that we had, which he'd received from ABN AMRO, refusing to allow delivery of his bullion, telling him he wanted to cash settle him. And this was just the beginning of a slew of similar refusal requests where an openly acknowledged 100 ounce of paper gold backed each physical ounce. And it threatened to topple the too-big-to-fail banks who had clearly not learned any lessons. And remember the televised and still available March 2010 CFTC Metals meeting, where industry apologist Jeffrey Christian argued the case that 100 ounces backed each ounce, and so what? Well, this was the moment it did actually matter. Gold is oversold. It's also not going unnoticed that gold hit its most oversold levels since its November 2024 $2,500 equivalent lows. However, most Western analysis fails to account for the Western paper to global south physical inflection point. But here's the point missed by analysts viewing gold through Western lenses, including zero hedges analysis. Gold is doing exactly what it was supposed to do when it was purchased, as they purchased originally, to hedge a black swan event, which we've just had. Now, obviously, there is a mechanical relationship between derivative gold and derivative real rates. So what are they backed by? Debt. But first-tier gold provided the necessary instant liquidity. And that was when all other asset classes failed. The gold price overshoot was caused by the PPT disruptively leaning into the plain vanilla mechanical sell-off, which in turn has successfully driven the myopic current mainstream media narrative, which claims gold has failed as a safe haven hedge. The PPT steps in to intervene in gold into all major market stress escalations. That's where they were formed for that purpose. But with physical gold liquidity now in the hands of China and the global south, the PPT's bandwidth, whereas in the past they had full control, it's now limited to how many leveraged ETF speculators, exchange traded fund speculators, can be flushed alongside the naked short momentums incentivized to take the short side, to take the load. Now, this added synthetically driven momentum action also forced some sovereign gold selling to meet dollar funding shortages, which just appeared into a spike in oil prices. But that short-term unfactored disruption has now been realigned, hedged in other words, meaning this so-called correction has now reached an inflection point where it's becoming too stretched not to be heavily leaned into by a tight for supply physical market. Now, a picture's better than 1,000 words. Let's take a look at the chart footprints, and that's going to, and then we'll align them with the various actors in play. This paper to physical inflection point was triggered on Monday when gold hit very large central bank bids on the approach to the rising gold 4,090 200-day moving average, which was a slightly lower, it's rising by about $6 a day, it was slightly lower on Monday. I'm recording this on Wednesday. And what it did was trigger insider short covering, very large size T+1 spot demand at both the subsequent fixes, AMP, and the PM fixes. What it did was it illustrated really provided the first visible sign of returning central bank and sovereign safe haven gold buying into rising oil prices, into the synthetically driven gold price correction. Now, while real rates or higher so-called real rates automates mechanical institutional selling and disincentivizes gold investments, the PPT has been utilizing this natural tailwind to target all remaining speculative longs, and in turn to tip the January momentum naked long buy mantra